Hello, and welcome to this month's episode of Credibly Challenged, the podcast on bank risk management issues. My name is Matt Bisanz, and I'm a bank regulatory partner with the law firm of Mayer Brown. We're going on a bit of a global tour today to meet some people across the pond who are involved in bank risk management and have some interesting insights on the development and possibly the future of parts of the capital regulation, not just in Europe, but also as it might be relevant to the US and in emerging markets. So I'm honored to be joined by William Perraudin. He is MD of Risk Control, a managing director at Risk Control, and his friend Georges Duponcheele, who is senior credit portfolio manager at MunichRe and teaches the securitization module at the University of Paris. Gentlemen, thank you so much for joining me today.
Good morning. Thank you.
Good morning. Yeah. Great to be with you.
Thank you. Great. William, I think we'll start with you first. And I've heard that in Europe, they're taking a bit of a different approach to the implementation of Basel Endgame, and particularly around parts of the securitization process. Could you talk why Europe is changing its rules in a somewhat different way?
Yes. So, the European authorities have wrestled with securitization regulation for over a decade. And so there've been a whole sequence of attempts to tweak the rules or to make changes to get the securitization market started again. But those have not succeeded. But by the way, because the European authorities also oversee the insurance rules, it's really, the combination of banking and insurance rules has really preoccupied financial policymakers. And right now, Europe has really low economic growth and concerns about investment volumes. And, there's a certain amount of fear and loathing or angst about the fact that the US economy can bounce back so well from COVID and Europe hasn't. And then, what's happening with tech investment in Europe and real economy investment. So all of this has persuaded financial regulators and central bankers that more should be done to push what they call in Europe capital markets union. So we have always had relatively atomized split financial markets, much more than North America. And so it's been part of the rhetoric and fundamental justification of a lot of economic policy making in Europe that the authorities should push towards a more unified set of capital markets. So progressively, I think the regulators have come to realize that banking is in the doldrums, that the market cap of banks remains really low compared with equity par values, much more so than North America. So our banking system here is not really recovered. And so how could investment be boosted? And so coming back to this notion of capital markets union, securitization then starts to look like part of the solution. It's part of the solution because it could boost bank lending without requiring a big injection of equity, which seems kind of implausible given the low profitability of the banks. And also it could contribute to, if you like, exchanges of financing across different European countries, especially if banks themselves were allowed, and this would be a very an unorthodox or heterodox idea for North American regulators. But if banks were allowed to invest significantly in senior tranches of banks from other countries. So securitization, on the one hand, is a way of doing risk transfer, and on the other hand, is a way of doing highly secured funding. And and exchanges of funding. Because, I mean, one more little wrinkle in all of this is that many central bankers in Europe are profoundly bothered about the fact that in the last crisis, bank intermediation or bank interbank transactions pretty much dried up, and the central bank became the route for banks with surplus funding to exchange it or to transfer it to banks without surplus funding. So basically, improving the interbank funding market through securitization might be another aspect. So that both risk transfer and kind of integration of financing across countries, both of those are rather novel ideas that could be pushed through securitization.
Yeah, I think it's always fascinating because in the US here, we are certainly more integrated as a financial system across the states. But as you noted, that we regulate things differently. So in the regulation of insurance is almost entirely divorced from the regulation of securities and also of banking. And I look back to in the 90s when there were US laws like the National Securities Market Improvement Act, or NSMIA, which really eliminated state regulation of securities offerings, of investment advisors, and that has had a profound impact on the speed at which we can get deals done. That when you're looking at the SEC's rules as the only rules, and you can offer on pretty much a nationwide basis for securities offerings, that is an amazing efficiency that we have. And also our banks, after things like 1993's Regal-Neal, which expanded interstate banking and branching, and again, just those kind of efficiencies that you end up with some of these banks in the US who will have thousands of branches across all 50 states that they can access deposit funding through and sell other products. That's just a scale that I think, from what you confirmed, is not really seen in Europe.
Yeah. I mean, bank integration could also happen through banks taking over other banks in Europe. It could have developed in that way, but things involving equity seem complicated. Do national authorities really want to see all their banks snapped up by major banks from other regions? There's reluctance to perhaps overcommit across frontiers, and I don't know. There are reasons why an equity approach to achieving capital markets union hasn't quite occurred. And then on the debt side, as I say, there are reasons why securitization is now being seen as more interesting. And there's another wrinkle in all of this, which is that the European authorities themselves use securitization in the way they do some of the financing of their own public sector banks. So the European Investment Bank and the European Investment Fund, which are very prominent institutions in Europe, they have in effect credit enhancements from the European Commission. So there are sort of ways in which securitization actually is used by the authorities themselves to do public banking, and that means that there's on the one hand still amongst some parties a kind of animus towards securitization, but then there are lots of other people who see it as a kind of pragmatic way in which Europe could start to try and achieve its objectives better.
It certainly sounds like there are more people at the table for these various decision-making exercises in Europe, that as much as we have the notice and comment rulemaking process here with our lengthy comment letters, there tends to be a bit more of agreement on direction, and the decision makers tend to be more concentrated. How do you think, in your experience, designing Basel II and comparing it to the Basel III process, how has the kind of different perspectives of people, or the more diverse and larger array of input in Europe affected the process?
Well, I mean, as background, 2 decades ago, I was an academic, but working part-time as an official for the Bank of England. So I was very involved in the calibration and design of aspects of Basel II, and in particular the securitization rules. And then I think, though, I mean, there was a feeling amongst regulators that that they didn't know everything. I mean, you might say, well, perhaps that was the problem with Basel II, that in fact there were big gaps in Basel II. There were things that regulation did that was sort of ill-advised. But it meant that they were a bit more open. I mean, I think, we published at the time a working paper. We set out the justification in some detail of the ratings-based approach. And there were other things. There was quite engagement with the industry. Some of my oldest friends and associates amongst investment bankers are people I met at that time when I was on the Bank of England side, and these guys were on were sort of making representations from the investment banks. So at the time, I think we were more open we were a bit more transparent in how we were thinking about things, and we were clear that other people knew more than us as regulators. So we were eager to seek input. And indeed, we were open to relying a bit on the rating agencies, because the ratings-based approach was all of that. I mean, built off rating agency analysis ultimately.
Yeah.
So
I
think now it's a bit more of a closed activity. I mean, it's the authorities give very little away in the way that the calibrations are done. And, George and I have for some years tried to assist the regulators by providing perspectives and scientific analysis. And so yes, in the...
Yeah, I mean, so something that surprises me on that is the fact that the Basel III rules, in particular the one that applies to IRB banks, so called SEC IRBA, the calibration has never been made public. There is no access to the data that led to that work. So from an academic point of view, we can't replicate those results. And we published as to how we made our own calibration and how far we were, departing from SEC IRBA. But it is strange and ironic to a certain extent that the famous formula for the P factor is used on, hundreds of billions, and even more soon once you have a Basel endgame in the US. And nobody has seen the publication on how that was calibrated in the first place. So it's the secret component so far in the regulation.
Yeah,
so
when
very
we were
opaque.
putting together our comment letter on U.S. Basel Endgame, obviously, as the P factor is hugely important in the U.S. here, and we dug into the history of it, trying to trace back to when the P factor was introduced as part of Basel II and what was the basis for it. And you're right, we did end up with oh wow, they said they did a study, but they didn't publish those results, and that was quite disconcerting to us from that perspective. But I think what you and William both raised is fascinating to me on the ratings-based approach that I really started practicing right after Dodd-Frank in the early 2010s. And so for me, the world has always been the Collins Amendment that effectively it prohibits reliance on the rating agency ratings, and it greatly disincentivizes use of the internal ratings-based approach in the U.S. And I'll often have even colleagues who've been practicing much longer, they'll talk about securitizations in terms like, oh, well, this is all AAA rated assets, or, Matt, this is really safe. It's prime this or prime that. And I'll people say things. I was doing a deal in Europe a few weeks ago where it was a European bank issuing through a U.S. entity, I think, and they were saying, oh, like, does it matter if we get this rated? And I'm like, no. In the U.S., we've forsaken ratings. That all of that analysis and science that was put into it, we've by congressional fiat kind of forsaken it, and Basel Endgame may slam the door even further. So that I just find that perspective fascinating, that we have shifted so much. And I know you guys have been working together for many years. What are some of the other topics that you've covered where you feel the European regulators have not given them enough attention or enough transparency?
Well, if we look at what happened in Basel III, I mean, the first proposal came in December 2012, and they had a series of methods, one called the Modified Supervisory Formula Approach, the MSFA, and they had completely changed the concept of capital. So you end up with having capital requirements with a particular concept for the asset, and then they change the concept when it was about tranches. So you ended up with an overall result that meant that the capital surcharge was 200%. We are now complaining about 100% or 50%, but the first proposal was a capital surcharge of 200%. Mm-hmm. So we started to, and this is how we met together, is that we started to design a principle-based approach by saying what are the principles that a capital formula should follow. And then you define the rules and you define the equations in order to come up with a risk-based model. And that allowed us to actually calibrate and to assess the non-risk-based proposal, which was the SFA. I mean, we used to have an expression that we don't put, in our academic paper, but only in our talks. We said, look, the SFA is brain dead. It needs a risk model to be calibrated against. And this is what the P factor was. It was an attempt to calibrate what is just an exponential function and to say, how are we going to match it with a risk model? And this is where we had, issues with the work. And then, thankfully, in 2013, the Basel Committee completely ditched the modified SFA. So nobody talks about it. It's a remnant of financial history. And they replaced it with SEC IRBA, which is what they had proposed for the standardized approach, and they had extended to the IRB approach. But that led to a certain concern within the European Central Bank, because they look at that calibration and they made a speech, which is now famous, by Yves Mersch, who was at the European Central Bank, and he said, those calibration is the same as if we were to do flood insurance calibration for Madrid, which is located on a plateau, on the basis of the experience of New Orleans. And that was quite a punchy analogy, which has been repeated many times, but that summarized very well the situation at the time. And they started with the Bank of England to join forces and to say, we can't have that. And they took a political decisions, a Gordian knot approach, which is to slice into two the capital surcharge, so the P factor. And they said, okay, we need to have some additional criteria in exchange of that, reduction. And this is how we came very much involved with the process. And William, that became STS and then STC, but there was a small history before that on high quality securitization. William, if you want to.
Yeah, so after the crisis, a bunch of the big capital market participants, primarily in Europe, started pushing for these quality labels on transactions. So there was a prime collateralized securities, PCS, was set up as a kind of industry initiative, and they started putting labels on certain securitizations as a kind of affirmation of transparency and quality. And so the authorities were aware of that, and obviously there were also criteria developed by the central banks as criteria for if you wanted to use a securitization to, as collateral for central bank funding. So there were these various sets of criteria knocking around, and that was picked up by Carney and Draghi, the two central bank chiefs in biggest major central bank chiefs in Europe, and they then pushed for this what became in Europe the STS. And the thing about that, though, is that this label became rather hijacked by the lawyers, I would say. I know you're a lawyer, Matthew, but
Yes.
I think I would still describe what happened as that, because we wrote a paper for STS trying to see what was the whether there was a real risk justifications for the criteria that they used in their label. So their label preceded STS, but it was somewhat similar in that they looked at characteristics of transactions and said, well, we want that, or we want this, and we don't want those characteristics, with the idea of making things more transparent and straightforward, aligning interests, all of that. And so we wrote a paper in which we analyzed how things that had their label, how did they compare with things that didn't have their label? And we showed, which were the characteristics that were led to lower risk. And it was rather intuitive. I mean, types of securitization that had refinancing risk, like commercial MBS, CMBS were risky, and things that had some sort of originate to distribute aspects to them were risky. And so, but what happened with STS once this was proposed by the two central bank governors was that basically it became a free-for-all for all, moderately senior but not top regulators, and then all their lawyers and everybody else on the official side to propose more and more requirements, many of which have nothing to do with the risk characteristics of the securities. It's a sort of a bit of a Frankenstein of characteristics that all sort of seem okay, let's put that in. But the net result is that it's become really quite onerous for people to satisfy these, and so it's become an impediment to the market. So in a way, and putting this all under the charge of
simplicity, transparency, standardization, the key word being standardization here, did not result in a pickup of the market in Europe. We have about 40 to 50%, depends on the year, might be 60% some years, of STS issuance, but a lot of that is retained and used for collateral purpose. It doesn't. It acted as a kind of rebranding to a certain extent for the market, at least with traditional securitization. It really helped on the synthetic side, on significant risk transfer. There it helped because it reduced the P factor.
Well, it's helped with the rebranding, but I think there's a lot of impediments to activity there. And the fact that it's presided over by ESMA, which is, all about eligibility and not presided over by the EBA, which is much more about prudential risk, is regrettable.
Yeah, I find it again, another fascinating point that it starts off with simple, transparent, and comparable securitizations, STC, and you're right, it has page after page of criteria. And when the U.S. regulators put out our Basel Endgame proposal, there were some people who said they didn't even mention STC in there. Why didn't they mention STC? The U.S. isn't going to adopt it. Why didn't the U.S. adopt it? And in talking with banks, we came to the at least what we think is the view of, well, this doesn't really work, that it would create a kind of bifurcated market like you're describing, where there are a few transactions that qualify for STC. They get the highly preferential treatment under the formula, and they're good. But then everyone else who fails any of those 100+ criteria, they are put in the non-STC bucket. They have the punitive criteria, and who wants to invest in those things? And so that I think was why, and the U.S. regulators haven't said why, but I could see that being a reason to not include STC in the U.S.
Yeah, I mean, there are legitimate reasons for the US people to think that it's not sensible. I mean, on the insurance regulation, I mean, also it plays a big role, because the capital charges for insurers are quite punitive for if they want to hold non-STS transactions on the asset side. So, and again, we did a study this time for AFME, the Banking Association, or the Financial Market Association, and showed that if you actually look at the spread behavior of STS and non-STS, there is a very small difference. It's not a massive thing, and yet the capital charges are like a very substantial multiple higher. So it's become a kind of a non-scientific, it's become like waving a flag that we have STS and we're punitive on non-STS, which is quite regrettable.
Yeah. Well, we've covered a lot, I think, of history, and I wanted to ask George and you about some of your current work with things like the risk-sensitive risk weight floor and how that is changing the debates. Maybe you give us a little preview of some of your upcoming work.
Sure. So what happened is that in 2020, you had something called the High Level Forum, which was created by the European Commission with senior people trying to see what can be done to make the capital markets union work. And they came up with a series of, recommendations, and one of them was to say that the risk weight floor may be too high and it should be reduced. So the EBA took this on board, and they wrote a study in December 2022, which indicated what they could do, how it could be reduced, knowing that in any case, it would be a departure from the Basel rules. And then we looked at it and we said, well, now that the issue is open for debate, it's time to rethink the risk weight floor, so that we have an understanding what is function in finance is and how it could be calibrated. So as we do in our paper, we tend to try to first understand where does the idea come from. So our paper on the risk-sensitive risk weight floor, people sometimes say, it's a bit long, but the history part is the most interesting, because we never knew what those regulators did, so many years ago. And the other part is to look at, the future, having understood why people are thinking this way. Now, one of the key things we have inherited from history is the fact that the risk weight floor, currently at 20% for your US listeners, but it is 15% in Basel for non-STC, and it is 10% for the senior tranche only for STC. But it's a fixed value. It's a one size fits all, regardless of the risk in the underlying pool. So if you have a pool of very risky assets, you have the same risk weight floor than for a pool of, prime residential mortgages. Now you end up in a situation where people are going to see that sometimes the risk weight floor is higher than the risk weight of the underlying pool. And that's, a financial absurdity. You can't have a senior tranche that is riskier than the pool. It's like saying, to go back to, Yves Mersch's analogy with flood in 2014, it's like saying, if you live on the third floor of a building, your risk of flooding is higher than if you live on the ground floor. Nobody would think that this person speaks logically. But in finance, we can't have that without anybody, complaining too much. Mm-hmm. So we thought that it is time to think actually what it's about. And we ended up with a proposal to say it has to be proportional to the risk of the underlying. And then we can have basically securitization of good quality assets, so having a low risk weight, and also the securitization that we have that is very large in Europe on leverage loans that have a higher risk weight. So that was the idea. And then because there are some nuances in the thinking and various risk parameter, we go into those different areas in the paper. But that is the key idea, is that a factor of proportionality is needed to really relaunch the market. We need to think a way that just one number in its absolute form will solve all the problems.
Yeah. And you see the market impact of having an absolute risk weight floor, which is that prime mortgages are not very actively the risk on them is not transferred through what we call the significant risk transfer market in Europe, which is a synthetic risk transfer market, which has been very active in Europe and a success story in many ways, and really a kind of safety valve for the banks, in that they've been able to manage their balance sheets effectively using this. But it's overwhelmingly been in relatively risky types of transactions. And, in such transactions, the bank retains a thick senior tranche. So if you have a high absolute risk weight floor, it's really going to discourage deals involving safe assets like prime mortgages. So it's a noticeable aspect of the market, the configuration or the profile of the market, that you see little SRT activity in safer assets, and it's really because of this aspect. So that's a striking thing for regulators, and so we're hopeful that they will consider our proposal of making the risk weight floor proportional to the pool risk weights, basically.
And when you have a new idea, it's very important, and this is something I learned working with William over the years, is that just describing a new idea will get you nowhere with regulators. You need to have, a way to calibrate that idea based on data. And this is why we are some other co-authors, on the paper who helped us to calibrate that. So we end up for Europe. We did not calibrate anything for the US. We only calibrated for Europe. We ended up at a 10% factor of proportionality. So we are saying that if the senior tranche, the risk weight floor should be about 10% the risk weight of the underlying pool. That's the core of the paper.
Yeah. Which wouldn't change things radically from the current absolute risk weight floor for things that are relatively risky, that have, that have 100% risk weight. But for things that have low risk weights, it would change things, and so it would bring the market back into line with the actual risks of the underlying securities, which really that should be the principle. And in all of this debate about prudential rules for securitization, the sort of underlying philosophy which we had back in the day when we were looking at Basel II, which is that there should be a strong connection between the risk weights of the underlying assets and the risk weights of the tranche positions secured against them. And so we were all thinking and considering our rule making as from the point of view of, is it capital neutral, or if there's a premium, is the premium a reasonable one? And so I think in this risk weight floor initiative that George and I have taken, we're sort of trying to come back to that. It's a novel thing in that so much of the industry has focused on the P factor. And so we're really pointing out that for the respectable bit of the market, which is, the investment in the senior tranches, and I mean, I'm saying respectable, but I'm not implying that mezzanine is unrespectable. But I'm just saying for the kind of staid conservative bit of the market, that needs to be considered too. And getting the risk weights appropriate there is really important. And the fact that you observe anomalies like no SRT or very little SRT with
high quality
assets it sort of points to the fact that things are not as they should be.
Yeah, no, for our listeners, it is something that I've been surprised at, that here in the US our banks hold tons of resi mortgages. That is one of the biggest bank holdings, and they are rarely the subject of synthetic or even private securitizations, in part because those would lower the risk weight from 50% to 20%. Whereas you're right, if you do it on something that is a higher risk asset like unsecured consumer loans, commercial real estate, unsecured corporate lending, that's 100% risk weight. So you're going from 100 to 20%, which is a significantly greater capital savings from the bank's perspective.
That's correct.
Yeah. One other item I wanted to touch on before we conclude, William, was your work with multilateral development banks. That my perception is they are much more involved in risk transfer in Europe than in the US, and maybe you could just share some of your experience.
Yeah, I mean, it's a very interesting global market, if you like, in the sense that there's something like 24 multilateral development banks in the world, 20 to 25, some depending on quite how you define them. But there's obviously the World Bank in Washington. There's also the Inter-American Development Bank in Washington. Then there's institutions in Europe, EIB, EIF, EBRD, and then there are institutions around the world, the Asian Development Bank and the the African Development Bank and others. And these institutions are viewed by the major countries and by the G7 and also the G20 as crucial to attempts to mitigate climate change or to make countries more robust to climate change around the world. So non-developed countries, how are they going to respond to all those challenges? Almost a decade ago, major countries set out development goals for 2030, and then also there are goals for moving towards climate, mitigating or kind of offsetting climate problems. And so all of that is seen by the major governments as part of the solution has to come from these development institutions. So they have limited equity. I mean, it's a sort of like the banks again. I mean, there isn't as much equity as you'd like. So how are they possibly going to gear up? And so there's then been a great push by, again, the shareholders, the major countries that own these banks, to get the banks to consider balance sheet optimization, and including securitization, but also risk transfer, traditional credit insurance, a whole set of different instruments and approaches. And that is a very vibrant, interesting area with a bunch of institutions amongst the development banks doing innovative things. So there've been transactions actually by the African Development Bank. The African Development Bank's been one of the most innovative. There's a deal that's coming out of the Inter-American Development Bank, synthetic securitization. And then there are a bunch of proposals, or actually things that are sort of just beginning, which are kind of platforms for syndication of loans and more structured initiatives that are coming out of places like, the World Bank institutions. Right. All this in the American side is being pushed by the American authorities, who are, when I say the American side, both the World Bank and the Inter-American Development Bank have a lot of impetus from the Treasury to reform what they're doing. So the World Bank has a new president, Mr. Banga, who was appointed last year, and he's been pushing initiatives around not so much securitization for the moment, but they are trying to group together a guarantee platform from their different institutions. So all of this activity is very interesting and exciting. And I think a lot of the private sector investors whom we talk to, in London, we've got lots of insurance companies, including George's firm, who are sort of keeping track of this with great interest. Yeah. It could be, if it moves as one hopes it will, it could be a way in which developed country investors can really start to contribute to development finance, find interesting debt or credit related investments in a whole range of countries that they wouldn't have thought of investing in. And they would do that by participating in risk transfers off the balance sheets, or jointly with more syndicated types of activities with the development banks. So it's quite an exciting, vibrant area, I think.
Yeah, last week I was actually moderating a panel on this topic, and it's not someone I play deeply in, but on the panel was, I think, George's counterpart at Swiss Re, and someone from New Market Capital, and they were talking about that African Development Bank deal that you mentioned, and how much they are doing in the space. And so I'm not surprised to see top tier institutions like MunichRe and Swiss Re engaged in this space, but I was surprised from the audience of American bankers who afterwards kind of said, we weren't even aware this was going on. We had no idea that this was a transaction class, and so it I think it's something to watch and be interested in.
Yes, there's lots of reasons why it's interesting, but another reason why it's interesting is that for commercial banks, the whole game is around regulatory capital. So everything revolves around regulatory capital. So then you think about development banks. What is it for them? Well, because they don't have regulators, but they're big issuers in bond markets, the effective regulators for them are the rating agencies. So everything they do in this risk transfer is measured not against Basel type rules. It's measured against the detailed rules of the rating agencies for development banks. So it's there's a lot of aspects of it. I mean, knowing what transactions are possible and what are not, you really need to know what are the constraints on the given bank that you're looking at.
Well,
So
George, William, I would like to thank you. This has been greatly educational, for me at least, about how the world is in another part of the world, and I always I value that, and I think our listeners value that as well. So thank you both for being on the program.
Thank
I'd
you for
also like
inviting
to,
us.
yeah, pleasure. Bye.
I'd also like to thank our listeners. Without you, we wouldn't have a reason to do these programs. So please do turn in for the next episode. Have a good day.